Hello, welcome to our second lesson at, my name is Sandeep Matai, and this is the Matai Trading University. We are continuing our session on option basics. We have been discussing, the first video was on the basic of options, calls and puts. What are they? And just to review, again, a call is a bullish bet and a put is a bearish bet. And in the first session, we just discussed simply what is a call, what is a put, how to buy it, what strike price is. That was the beginning. And today we will continue from there to continue on other methods and uses of these options. So today we're going to start with option spreads. Many times you will hear us talk about call spreads, put spreads, vertical spreads. So today we want to continue on, what are spreads and why do we choose to do spreads. So a spread position is entered by buying and selling equal number of options of the same class on the same security, but with different strike prices and sometimes different expiration dates. They're also known as vertical spreads or debit spreads. And I'll give you an example, but there are some reasons why we choose to do spreads. Again, you could buy, for example, a call and you pay X number of dollars, or you could reduce that cost by buying a spread. And we do spreads because they have less capital requirement. A call has a certain amount of money that you have to pay, which is lower than the stock price, of course, but when you do spreads, it even reduces that more. And also, if you're incorrect in your option or your choice, it's a smaller loss because it's less capital outlay. And then you also reduce the loss of time decay and volatility, which we'll talk about, when you choose to do spreads. And then the drawback is by doing a spread, you're also giving up some upside. When you buy simply a call, you have unlimited profit versus doing a spread where you have you have limited profit. But again, just like a call or a put, as long as you're buying them, you can only lose your investment. You cannot lose more than your investment when you're buying, or when you're buying a call or a spread or a put spread. So again, the risk is limited when you're buying these things. Okay, so we're going to just do some examples of what are some of the spreads. Let me put another screen so I can refer to it. Okay. All right, so we are going to first look at how to set up a spread. Okay, so let's just look at anything. Let's look at Amazon. Let's look at the chart of Amazon. And we always refer to charts for entry points, exit points. So this is the chart of Amazon. Amazon is roughly $1,760 a share. If I wanted to buy one share, it'd be $176. $1,762 per share. If I wanted to buy 100 shares, that'd be $176,000. Or I could buy a call, for example, a November call. Again, we're looking at the closing price was $1,762. Roughly, we can say, we can kind of look at something like $1,762. So we could spend $176,000 for 100 shares. Or we could spend about $5,000 roughly to control 100 shares until November 23 days from now. That would be $5,000, a lot less than $176,000. But even that's a lot. How do we reduce that? So what you do when you're buying a call spread is you buy one call. So I'm putting an order to buy this call here. Let's say it's this price. And then I want to sell one above it to reduce this cost. So I could sell a 1,800 call above it. Okay, so I buy the lower call and I sell a call above it, and that reduced that cost from about $5,000 to $1,600. And this was calculated by taking this $5,000 roughly and subtracting off roughly $3,400 for this top call. So 5,000 minus 3,400 gives you 1,600. That's how that's derived. So again, you buy the lower strike, and you sell a higher strike, and you have to, that way you pay less for the whole structure versus just buying the call or buying the stock. Okay, so now the benefit again of this is that it's less cost, and the only drawback is, well, one of the drawbacks is that you're limited to profiting until 1800. So this is at 1762 right now. You will have profits up to 1800. Beyond that, your profits are capped off. So you have profits from 1765 to 1800 is where your profit range is.
Sorry, I'm not sure if I'm the only one, but I just see I don't see your screen share. I'm just seeing the welcome Matai Trading University on my screen. Am I the only one? Is everyone else?
Anyone else seeing my screen?
I'm seeing you just fine. I'm seeing your active screen.
Okay, you're seeing my screen.
Seeing your active screen.
Okay, so something is wrong with mine.
Maybe it's a delay. Yeah, I don't know if it's a delay or what, maybe. Okay?
Yeah. Okay. Yeah, I'll just disconnect and come back, but you continue.
Sure, thank you. Okay, so again, this is the call spread, okay? And I'm going to refer to charts. Now, how do we pick prices? Basically, this comes back to technical analysis where we look at charts. And what I usually do is if I want to buy a call, I will choose to do a call spread because, again, it's less cost. And if I'm wrong, I will not lose. In this example, I would not lose. If Amazon shoots downwards, and I won't lose the whole $5,000. I will lose $1,600 in this worst case scenario. If the thing collapses by November, I lose that. So it reduces my cost and risk. So how you choose the strikes of a call spread, in my thought, is you buy it at the money, generally for me, and then I will look for a resistance point, and that's where I want to sell the top portion of the spread. So again, I buy it where it kind of is right now, and I will usually look for resistance points. So here in this case, if I was bullish on the stock, I see there's resistance. Again, that's the ceiling where prices have hit around 1835. So I don't want to necessarily buy a call from here to unlimited because, under normal circumstances, aside from earnings, this thing on earnings, of course, can shoot up a couple hundred points, and that's fine. But I'm just speaking generally. I will look for resistance points to find my upper strike. So here, I might pick a 1762, and I might pick a 1835 as my target. So I would come back here, and I would buy a 1762, and I would sell a 1835. And sorry, I'll do it together. Okay, in our platform here on Thinkorswim, we can enter it like this also. Just FYI, you click the right button, you push buy, and this is a vertical. You buy a vertical, so you can do it this way: 1762, and you would sell at 1835 in this example, and you pay about $29.50 roughly for it, and that is your call spread. Now, again, this is your max risk. This is my target, so I would be setting this up this way in this example. If I was bullish, if I thought it was going to go up to this price, I would do this structure. And again, you enter it by buying the lower strike and then selling the higher strike, and the difference between these two prices, it comes over here, okay? Buying here, selling the lower strike. This is your strike month. You can do this on any month you want. If I want to do December, I could do January. So you can pick whatever month. So that comes to your outlook, your scenarios. Okay. And again, why do we do this? Is because less capital, and also if we recall, when we are buying an option, there's that theta or time decay burn that's happening. So you have a time decay burn here. But by selling the higher call, you offset some of that. So this is roughly $50 a day burning right now. I could offset $30 of that by selling one above it. So then I'm only losing $25 roughly. So again, it's also to reduce that difference in the time decay. So that's why we choose to do spreads for those two big reasons. And again, your max risk is what you pay for it. And so again, we look at charts to determine the strike prices. So buying a call, selling a call above it. And now I'm going to give you an example of the put side. If I was bearish on Amazon, or if I wanted to buy protection, if I have stop, let's say, I could buy a put and pay, let's look at a 1750 put, for example. First of all, if you want to be bearish, you could short the stock, and that takes a lot of capital because it's 17 or 62 per share, and you have a lot of unlimited risk. If something happens and this thing shoots up, you're in a lot of trouble. So that's why if you're bearish, it's always, in my opinion, better to do just to buy simply a put or a put spread. Or if you're protecting yourself, and for protection, you can buy a put. I could buy a 1750 put, and I'm protected all the way to zero. Now, 1750 put roughly on Amazon costs about $4,400 for every 100 shares. You could do that. You could buy this, and you have a put for that price. Again, you can reduce this cost by buying a put spread, and you simply are picking a point where you want protection from, or where you're bearish from. If you think this thing is going to go to, let's say, 1600 or 1650, let's just say. Let's say we're like, okay, well, this is the next support level right here, 1670, let's just say. 1670 is my next support level on the charts. And we always combine the technical analysis with this stuff. So let's just say that's where we're assuming that it's going to drop from 1750 to 1680 roughly. We're going to buy a 1750 put. We could just buy that put and have unlimited profit potential to zero. Or we could reduce this by selling a lower put, let's say a 1680. And if you have Thinkorswim, I'm holding control to get the second one in. And then all of a sudden now I pay about $2,400. I get protection from 1750 to 1680, or if I'm just making a bearish bet, I have profits from 1750 to 1680, about 70 points difference in there. If this thing goes to 1680 or below, you make the 70 points minus what you pay for it. So roughly 56 points or 46 points, $4,600 roughly is your potential profit. So again, you choose your strikes. The further low you go, the more you pay, and vice versa. So again, you're simply buying a put and selling a lower put in a put spread, opposite of a call spread. So to review, how to set up the spreads is what we're talking about. Call spread, that's when you're playing it long, is a bullish position. It has limited risk, but it also has some limited profit. Again, limited risk. You only can lose what you pay if you're long. So you're buying a call and selling a call above it of the same expiration. And you can use technical analysis to determine the strikes, is what we did here. Put spread is the opposite. It's a bearish position. Also limited risk, limited profit. You buy a put and you sell a put below it of the same expiration. Okay, I'm going to go back to these, but I want to show or discuss what are risk graphs and risk profiles. These are also known as profit graph. It's a 2D graphical representation that displays the range of profit or loss possibilities for an options trade. The horizontal is the price, and the vertical is the potential profit or loss. So I'm going to show you an example. So if you have Thinkorswim, it's under Analyze is where you can get these, and there's a risk profile here. So again, if you have Thinkorswim, now if you have a different broker or platform, I'm sure they have a risk graph or risk profile somewhere. So let's enter Amazon here, okay? So let's do let me get rid of these simulated trades. Okay, so let's start from scratch. Okay, now I just want to show you, if I buy 100 shares of Amazon, okay, I'm going to look at the risk profile. Okay, again, this is a risk graph. This is where we determine, we kind of visualize profits and potentials. The bottom axis is the price. Right now, this dotted line right here shows the price at close today, 1766. So that's here. The bottom is the different prices, and here is potential profits. Okay. So if I were to buy 100 shares of stock, where it closed today, let's say, for every dollar, it goes up, I make, for every 100 shares, I make up, let's say 10. If it goes to 1850, I make $10,000. If it goes to, next up, I make $20,000. On the downside, if it goes down 100 points, I lose $10,000, and so on and so on. So this just shows you for profit and loss graphically. Okay, prices and profits. Okay, and then here we have delta, gamma, theta, vega set up here. So delta for a regular buying the stock is 100 because I own 100 shares. The delta is 1 to 1. And there's no theta, there's no gamma, there's no vega because it's stock. Okay, so we're going to compare that to a call. If I buy a call, 1765, let's say roughly. Okay, I'm going to unhighlight this risk profile. Now, you'll notice a difference here. Okay, again, going back to the stock, if you look at that, a stock has losses that are unlimited. If this thing I'm unlimited to 0. Okay, this thing loses money constantly. If it goes up, it makes money. Okay, so now look, when you buy a call, all of a sudden, okay, let me explain these lines. This is the expiration line. This is what it would be at expiration. If Amazon was at 1950 at expiration, you would have the profit shown here, roughly 13,800. It's also shown here as I move along. And the pink line is today, at this moment, or this day, in one day. And this line will move toward the expiration line as time goes, whether it be up or down. So in this situation, when we buy this call, as the stock moves up in price, we are making money. Everybody's happy. We're making a good return on our money because we are paying $5,000 versus $176,000. So your return on investment is much better on a call versus a stock. Now on the downside, if this thing collapses, this line does not keep going to infinity or 0. It stops. It's capped off at the premium, $5,000. So you see this has unlimited profit but limited risk. Okay, so this is shown here. If nobody has questions on this, okay. All right, so this is the risk graph. So we compared it, stock and a call. Okay, we're going to go one step further. Let's say we want to do a call spread. Let's say we're going to buy a vertical. Okay, I'm going to come down here. I'm going to let's say 1765 to 1800. Let's say that's what we choose. Okay. Now here we're going to pay $1,600. We're making a bullish bet, but we're capping off potential gains, but we're reducing our cost outlay. Okay. So let's look at how that graph looks. So that graph looks like this. Okay. So at this point in time, again, this is the expiration line here. This is the one-day line, okay? So if today this shows you, if this thing shoots up to 1800, you're going to make $400. If it shoots down, you're going to make $400. And every day this pink line slowly moves closer to these final lines, okay? Now, if you'll notice, if the price increases, you're making money. Let's look at the expiration line. You're making money, but your gain is capped off here at this line, which if you look over here on the left is at $1,900. Okay, so you're making between 1765 to 1800, roughly $3,500, and you're taking off your debit that you pay. Okay, and that is your profit. So 1900 is here, and on the downside, the max you can lose is what you paid for it. So again, if this thing collapses at expiration, you can lose the max of what you paid, which is $1,600. Okay, so you can only lose what you pay, but you can make more, and you determine your upper strike. I could choose 1835, like we showed, and this changes the cost. So here, I can lose 2,800 if I'm wrong, or I can make, if you look here, $4,100 roughly if I am right. So you choose your width of your strikes, what we call it. And again, this is a vertical, or some people call it a debit spread. It's a debit spread because you're paying for it. It's you have to pay a debit, and it's not a credit received. Okay, so basically the risk profile of a vertical call spread is like this: max gain, max loss. Your losses are capped, your gains are capped, your investment is lower. Okay, and this is the risk graph for that. And I'm going to show you for the put side in a second, if there's no questions on the risk graph so far. Okay, so these are examples. Now we're going to look at a put. Okay, we're going to look at puts, same thing. Okay, if I wanted to short this stock, 100 shares, okay, I have gains here. Again, this line is my line for a stock. Gains here, and losses down to all the way to zero. I mean well, when you're short a stock, it's really unlimited. I mean, this thing can go to 3,000. You know, it can go as far as it wants. Zero is not the limit. So again, unlimited risk, unlimited reward when you buy a put. I'm sorry, when you short a stock. Now I could buy a put and achieve a similar result. Let's just say at the money. At the money, again, is where it's at right now, roughly. Let's say here. Now, if I look at that risk graph, now notice again, this was shorting a stock, and this is buying a put. Here, you notice that on the downside, on the downside meaning if the stock goes upwards when you're short by buying a put, your losses are capped to the amount that you paid for the debit. But on the other side, you can have, unlimited gains on this. So again, your losses are capped. If you're short a stock, you have unlimited loss. But if you're buying a put, you have limited potential loss, which is the cost that you paid for the put. Okay. Now we're going to do the example again of a put spread. We're going to analyze by a vertical. Let's say 1762. And let's say 1725. Okay, here we're taking a bearish bet. We're going to pay roughly $1,600 for it. If the stock goes up, let's see. Sorry, if the stock, let me make sure this is right. But yeah, if the stock goes up, I make money, and if the stock goes down, I lose money. Okay, let's make sure I did this right. So, yeah. Okay, so you can only lose the max that you paid. Okay, so you can lose, you can gain if the stock. I'm sorry. If I'm buying a put spread, if it goes downwards, I make money. So again, if it goes down, I can make up to the 2160, which is the difference between these two strikes minus the debit that you paid. So remember, you're paying this to play the game. And then you make the difference between these two strikes, deduct off your debit, and that's your potential profit. So again, in this case, if this stock goes down to below this level, you can make up to $2,160. And if it goes opposite direction, you can lose your debit, which is about $1,600. So you can lose a limited amount, you can make a limited amount. And again, you adjust these strikes based on your outlook. And again, you can look at the charts to determine, okay, I want to get short here. Where's my next potential? Maybe I could say 1,600. If this thing falls, I could buy a put spread from here to here. And I make that difference. I make that amount minus the debit paid. Okay? So risk profiles here. And this, if you notice this little red line right here, this is your break-even point. So this, at this moment in time, 1747 is where I would have no loss or gain. Anything below that is where I start to make money, and above that is where I start to lose money. So if it ends up somewhere here at expiration, you might not lose. If it ends up somewhere in between these two strikes at expiration, You may not lose the whole amount, you may not gain the whole amount, so it depends on where it's at expiration. And again, with options, you don't have to wait till expiration to sell or to take profits or losses. You can take them anytime, in the next second, in the next minute, the next day, the next month, whatever you choose. You don't have to hold to expiration. Every day, they're either making money or they're losing money. So you choose when you want to take it off. For example, if I buy a call spread and it's up 20% in my experience, I usually just take it off, take the profits and move on. Because you don't want to be greedy. A lot of times it'll work out and going in a direction and something crazy happens at expiration or close to expiration, then you lose all your potential profits. So that's, again, my opinion. Some people like to hold it. That's fine. On both sides, okay? So these are call spreads. This is your break-even point and max gains or losses based on what you do. And over here is where you can see your position, the delta. So at this point in time, if I buy this put spread, sorry, I'm going to start with the put. If I just buy this put at this moment in time, I am in theoretically short 47 shares roughly by buying this one put spread. And then my theta I'm losing is $106 a day at this moment in time. And this is the volatility factor. This is how it's effective. Volatility affects this, which I'll go into later. Okay, so delta and theta are here. If I buy a stock, it has no delta. It has 100 negative delta. And if I buy a put spread, the delta changes to minus 11, and gamma's here, theta's here. I'm losing less money per day by buying the spread versus the single put. So if you buy a put, you're losing much more theta per day than buying the spread. That's why we do spreads, to reduce that. Okay? And also to offset some volatility potential problems. We also do that. And this delta will, as it goes into your strike, this delta will increase, get closer to negative 100, the deeper it gets into your spread or strikes. So this increases by the gamma. Okay? So that's the risk profile. This is how you look at the delta, gamma, theta. If I combine several positions like I do, you can combine several positions in any stock, and you can look at your total delta. You can look at your theta and your vega and all that stuff. Okay, so that's what I usually do. I combine many positions to look at the theta and the delta, and then that's what I kind of go by. And this is your combined risk graph of all positions. So you can do that on any platform. Okay, so risk profile, risk graphs. Hopefully you understand those. If you have any questions, please ask. So we set up the spreads, we looked at the risk graphs, risk profiles, okay? So this first session and today so far has been all about buying options, buying calls, buying puts, buying call spreads, buying put spreads. If you buy a call spread, it's a bullish position. If you buy a put spread, it's a bearish position, okay? Those are all spreads. These have limited risk, okay? Now I'm going to switch gears so far at this moment and flip the script and look at selling options, okay? So we've been talking about buying. Now we're going to look at selling options, okay? That's what a lot of options traders do, is they sell options. They buy options. It seems like they sell more options than they buy because options traders realize that there's a depreciating asset. They figure out how to capitalize on that, and they take advantage of it. Again, no harm in buying options at all, or spreads or anything, because you can make a bullish option or a bearish bet by buying calls or put spreads, and that's perfectly fine, and it's a good way to make money, and it should be a part of your arsenal to be able to do that, especially if and when we get a downturn, which I'm sure is going to happen. You can make a lot of money just simply buying puts or put spreads and just wait and just watch it just explode and benefit you, okay? So that was buying. Now we're switching gears, looking at selling options. Unlike buying options, these entail unlimited risk and limited reward. So it's the opposite. Now the risk is somewhat limited in option spreads. So I'm going to talk about those. It's basically the opposite. So again, they have unlimited risk and a limited reward. Okay? So if you sell a call, your max gain is the premium collected. So premium. Now, when you were buying a call, that is what you paid. That premium is what you pay. So all these that we looked at here, these are premiums that you're paying. Okay? So that is the premium. So when you sell a call, so there's two sides to every trade. When you buy a call, somebody's got to sell it to you. So they sell you that call, you pay them the premium. They keep that premium. If it goes in their favor, they keep that premium at expiration. They're happy. You're not so happy. Okay? So selling a call, the max gain is the premium collected. Now your max loss is unlimited. Okay? And then when you sell a put, your max gain is the premium collected, and your max loss is also unlimited. Okay? And again, the premium is the amount collected in selling the option to another party. There's the buyer and a seller for every transaction. So when you sell it, somebody's buying it, and vice versa. Okay? Now, why do we sell options? Time decay. Biggest reason. Every option is depreciating. When you're selling an option every day, you're collecting that premium if you're right in the direction. Okay? That's the one main reason. And also volatility is a reason for options. If you are bearish on volatility, or if you think volatility is going to drop, you can sell options. And volatility is a factor in the pricing of options. So if volatility is increasing, generally options are increasing in value, especially on the put side if the market is dropping. So if you are betting that the volatility is going to drop or at extreme levels, you sell options to take advantage of the decrease and the time decay, both. So again, that is another reason people sell options. Okay, drawbacks, high risk, and limited reward. Okay? And again, to reduce the risk, we sell spreads. Okay? I would highly suggest that you never sell naked calls or puts, because you don't know what's going to happen. Things can explode, things can collapse. You can have a CEO get arrested. I mean, anything can happen with any company, good or bad. It can get acquired. Anything can happen. So don't ever be naked. Now, I'll be guilty of saying that sometimes intraday, I do take some naked option positions, but generally speaking, at the end of the day, I cap off everything. I never leave any risk overnight to the best of my ability. I might do really wide spreads, but I'll always have some garbage protection just in case. So again, I'm not saying go and sell options naked. Do not. It's not a good thing to do. You will get burned. I have gotten burned from it. So again, let's look at some examples of what do we do. Okay, so let's look at a bullish position. When you take on a bullish position of selling options, that is called a bull put spread. Okay? So if you're bullish, you can do two things. You can sell a put. It's the opposite. Instead of buying a put, you're selling the put. That has unlimited risk. Okay? Or you could sell a put spread. You sell a put and buy a put under it. Okay? These positions are bullish. These are called bull put spreads or bull puts. Okay? So let's look at it. Let's look at something. Okay? Let's just say I think Amazon is gonna stay above $1,600. Okay? I'm bullish on this thing. So I go and I look and I see, okay, I'm gonna get rid of all these. So again, I could just simply buy the stock if I'm bullish, but that's a lot of money to pay. $176,000 for every 100 shares. That's a lot of money. I could go and buy a call, or I could take advantage of the option market and just sell a put. I could sell if I believe that Amazon's going to stay over 1,600 by November, I could sell a 1,600 put. Boom, right there. Okay, I've sold this put. I bring in about, let's just say $700. Okay, let me risk profile that. Okay, so if we could sell a 1,600, this is a bullish position. If you look at the delta, it's positive. I'm not negative delta, I'm positive. And look at this though. All of a sudden, instead of theta being negative, it's positive. Again, theta is time decay. That means every day on this position, I'm making $51, and this amount increases the closer it gets to expiration. Okay, they become more, it increases greatly as it gets closer. This might be 70, becomes 100. So now look at this risk profile. If this stock goes up, I make, no matter what happens here, if you notice, I make this amount right here, $700. That's what I make. The premium that you collect is the max that you can make, okay? That's the max you can make, okay? You, on the other hand, are on the hook for the downside. If this thing collapses, you are on the hook for every dollar that it goes under $1,600 minus the, you got some premium, so you can take that $700 away. So everything below that, this is your break-even point right here, $1,593 roughly, because you took in $700. So right here, anything below this, you're losing money. The further down, the more you lost, and then the closer and the less the loss. Okay, so this means it's unlimited risk but limited reward. Okay, the benefits, data. Okay. And then Vega, if you look at volatility, also your negative Vega. If volatility drops, you're making money. If all of a sudden something happens with Amazon, volatility will increase. If it drops, this will get pretty big, and you are taking advantage of that if you're betting the other direction. Okay, so unlimited, limited reward, unlimited risk. Okay, and again, just like the other side, we can also sell. This right here gives me unlimited risk. So if I don't want that unlimited risk, I go and I buy a sell a vertical. Okay? And let's just say I believe that it's going to go from, I don't think it's going to go below this, but if it does, I think the next stop probably is about 1,500, let's say. I want to protect myself. So what I do is I go back and I buy myself a put spread, 1,600, let's say to 1,500, okay? Let's say I buy this 100 point, okay? So now here, if you notice, let's just say 4.9, let's just say 500 for simplicity. Okay, so in this example, I get less credit, okay? But all of a sudden, your loss is not unlimited, okay? So by offsetting and buying a protection put under it, 1,500, you're only able to lose, in this case, $9,500 in this example of a very wide strike put spread. Okay, so you can make, the max you can make is this credit received, $500, no matter what happens if it's above. Then this is your break-even point, $1,595 roughly. Below that, you start seeing losses, and if this thing really collapses, you can lose the maximum of this amount, but not unlimited, because you have bought a put spread. You protected yourself. So what you're doing, basically, you're selling a put, and you're going out and you're buying a put from somebody else for protection. And that's what creates this put spread. So this is the selling side. We're selling this. On the other way, we were buying this. Somebody's buying it, and you're on the other side selling it to them. Okay? So it flips. If you look at the graphs, this was for the other side. That person can only lose that. You, on the other hand, can lose the other side. Okay, so it's just the exact opposite of buying and selling on the risk graph. So we're selling a put spread in this example, and that is how you do a put spread when you sell it. This is a bull put spread. Okay. Now we're going to flip it on the call side. Okay, we're going to look at a chart, look at Amazon. Let's just say I don't think this thing is going to go over $1,900, okay? So I'm going to go, I could short the stock, but that's a lot of money, a lot of risk. I'm going to sell a 1,900 call. Okay? And just to note that Amazon earnings are coming soon, tomorrow as a matter of fact, so these premiums will be a little more elevated, and they will drop a lot after earnings. But we'll just use this for example. So if I wanted to sell a 1,900 call right here, okay, so let's go to analyze, add simulated trades, 1,900, okay, and right here, okay, 1,900, okay, risk profile, okay, it's here. I can make this as a maximum amount right here. $845, you'll see it here. Okay, or I can have unlimited losses if I'm wrong, if this thing shoots up higher. Okay, so same thing. I sell this naked call. This is a naked call because there's no protection. I have unlimited risk, so it's a naked call. Okay, I could do that, or I could say, okay, well, I think 1900, but I want to protect myself at 2000. Sell a vertical, 1900. Let's say we buy at 2000 above it. Very wide. Okay, so let's just say $640. Okay, risk profile. Again, we're selling a call and buying a call above it. We take in a little less credit. Okay, so max we can make is $640. And the max we can lose is here, which is, a lot. But this is a 100-point strike. Generally, most people don't buy it this wide, but you could. So you could do that. So you could lose up to $9,400 roughly, and you could make up to $640. And your break-even point is right here. This is where your losses start at this point, and below that you lose. Okay, so max reward, limited reward, limited risk is limited. Okay, and you choose. The more you bring it in, the less the less you can lose. The wider the strikes, the more you can lose. Okay, so use your choice on what you do. Again, you can use technical analysis. Okay, so these are selling a call spread or selling calls is a bearish position. Okay, you're doing the opposite. You're selling calls because you're bearish, and you're selling a call spread because you're bearish. And this is called a bear call spread or a bear call. So this is a bear call if you just sell the call, or a bear call spread. Okay. So again, bullish position, bull put spread. Bearish position, bear call spread. Okay, above are limited risk, limited reward positions when you do the spreads. If you do them naked, it's not limited risk. Okay, so and again, I talked about using technical analysis. I'll just touch on that briefly to pick points. So hopefully everyone understood about spreads. You're buying a call, selling one above it if you're bullish, and vice versa if you're bearish. On the put side, same thing. Okay, so. And just a note, I'll just put it out there. If you sell a put, okay, let's just say Apple. Let's just say I sold a 220 put. Because some people may be wondering what happens if you don't buy it back and you let it go to expiration. What happens? Okay, if you sell a call, I'm talking about selling options. If you buy an options, if it's in the money at expiration and you don't take it, you will be basically exercise the stock, and the stock will be in your account. If you buy a call and you don't close it off, it's going to go in your account as owning the stock. Okay. Now, what happens on the flip side? If let's just say I sell a 220 put right here, okay, let's say I take in $125. Okay, what happens is if in this case, let's say at expiration you sold this put and Apple's at 200. If you don't, you're going to be in a loss. Obviously, you're going to have to buy it back for a higher price. If you don't take it off and pay the loss, you are going to be put the stock. When you short a put and you get assigned it, you will have 100 shares of Apple in your account at $220 a share. That's the worst case scenario. If you just don't do anything, you are put the stock. Okay? In the worst case scenario, if you don't do anything and close it out. If you have a short put, okay, you'll put the stock at this price. Okay? And then you can hold it and wait, and if the stock comes up, you might end up making money on the stock, or you can liquidate, your choice. You can take a loss. And some people do get put stock and are okay with it. And that's why I just wanted to touch briefly. Some people will sell naked puts to buy stock that they want, and I'll just touch on that briefly. And I do that sometimes. So if let's just say, I really want, I'll just look at anything. I'll look at Netflix. Okay. let's just say I really, I'm looking at Netflix. I think at 240, I would love to own this stock because it's got support there. So 240 is not there, but that's where I want to buy it. Okay, I don't want to buy it now. So you can kind of take a reservation on it. You go and you sell a 240 put. Let's just say you did that. Okay, analyze. Let's look at Netflix. And we are going to sell a 240 put. And let's just say December, just so you get more money and more time for it to work out. The more further in time, the more money you get in premium. Okay, so let's just say I want to sell this. Okay, oops. Okay, I did 245. Fine. Let's just say that's $500. At 245, I want to buy the stock. Risk profile here. If I sell this put, I can make $500 if the stock never goes down there, or I will have losses below this. Okay. So what people do sometimes is they will sell this put where they want to buy the stock. So it's kind of a win-win in that scenario, because if the stock never goes to 245, you get $500 just for doing this. Okay? And if it does go down there, you are put the stock at 245. Of course, if the stock drops below 245, let's say 220, you own this, you are put the stock, you did get a $500 premium, but you were put the stock at 245, and then you basically own it at 245, regardless of where it's at. If it's at 200, you're owning it at a loss. You did get the premium to offset some, or it may be that it gets down to 245 and it goes to 240. You own it and it comes back up, and you're happy because you got that premium, and you get to make money on the stock eventually. So again, some people do get. Let's see. Sorry, I'm sorry. Okay, what's your one question? Okay, I'll get back to that. Okay, so again, people sell puts to buy stock. Worst case, if you're put a stock, you own it, and then of course, they take that money from your account to cover the stock price, but you own it. That's your worst case scenario. So it's not the end of the world if you sell a naked put and you are assigned the stock. Of course, you don't want to do that unless you know what you're doing. But people do that. I just wanted to tell you that. Now, on the flip side, if you sell a call, let's say 250, you've taken this premium. Let's say the stock goes to 270. Worst case scenario, you receive the short. You receive the stock short. You are short the stock at 250. It's the opposite. So if you get assigned this above 250, you are short the stock 250. You're losing money as it goes up. If the stock comes down at some point, you're fine and you make money. Okay? So, again, these are nakeds. And again, I don't suggest doing this, but I just want to tell you the worst case of nakeds is that you are either put the stock on the downside or you are short the stock on the upside, and you have unlimited loss on this way or this way, depending on which one you do. Okay? So, okay, and someone asked, instead of buying a call, sell a put when volatility less. I'm not sure if I understand the question. Let's see. Instead of buying calls, what other reason? Okay, I'm not sure what that means exactly, but so you can, again, if you want to buy a call, you could either buy a call or you could sell a put. Now, the drawback on selling a put versus buying a call is that you only make the premium. So if you're really bullish on something, you would rather buy a call because a call has upside, limited upside. So again, if you're bullish, you have two options. You could buy a call and have unlimited upside, or you could just sell a put. But remember, when you sell a put, you're only making that premium, okay? And so it's your choice, how bullish you are. Again, if you're really bullish on something, you have a good feeling about it, just buy a call. And you have unlimited upside, or you could sell a put and or you could do both, which many times I do. I will sell puts to pay for my calls. For a really bullish position, you can do both. And again, if you sell a put when volatility is high, as it decreases, that put gets less costly, and you can buy it back and make profits. Okay, so that was your worst case scenario of getting assigned. Call spreads, bull spreads. and how to use technical analysis. Again, supports are kind of where you want to buy calls or sell puts under, and resistance is where you want to sell call spreads above. And again, spreads, not naked. Sell call spreads up here, sell put spreads down here, and if all goes well, you can make money, and you can do both. You can sell call spreads here, and you can sell put spreads here, and if this stock stays in the middle, you're making money here, and slowly time is decaying on both sides, and that's what I like to do a lot of. In the next session, we'll get into iron condors, butterflies, covered calls, and the different strategies. I just want to make sure you understand the foundation, because all these are the building blocks of setting up the more complex trades for earnings and generally. So today we discussed spreads, we discussed risk graphs, and I think I'll leave it at that unless anyone has any question. Hopefully that should have given a good explanation. And once it's all, this video is done, I'll put it back on the website. So if there's any other questions, and if not, we will end it here. And next time we'll pick up again with more complex trades and so on, because I want everybody to be built up and understand the basics first. Okay?